you cannot finance a war and kill millions of people if you have hard money. I was in charge of $500 billion of bond issue, and that was with Goldman Sachs in London. And I think they are entering what Besant and Trump call the spiral of death, which is a very negative spiral of death. Nobody wants war. I call war, because you said good, I'll tell you what's good. All currencies which are controlled by governments are being debased. If you want to have an ethical monetary system, you need to have hard money. A currency that cannot be printed by the government. War is borrowing money from the future generations to kill the current generations. So NVIDIA alone is bigger than the entire Russell 2000. A lot of startups with no revenues which are getting valued in the billions. That's really very dangerous part of the market for an investor.
If you're pushing for a higher valuation now at, let's say, pre-seed, seed, I mean, how are you going to sustain that in this market at a series A or B? It's like running a marathon, but starting sprinting. That means 93% of those companies just vanish.
I'm going to say this in a bit of a Silicon Valley way, which may be seen as a little bit mean.
You're an entrepreneur
Yes.
and an investment banker.
Both.
Let's define both.
Yes.
What's an entrepreneurship to you?
So entrepreneurs are those species of people who overestimate opportunities and completely underestimate risks.
Overestimate opportunities and underestimate risks.
Optimists, we call them, yes.
Which is the optimist. Okay, tell me more.
And it's a very specific kind of person to become an entrepreneur. And when people look at entrepreneurs, they see the success stories, the people who've been around for 10 years like us and others, the people who built companies which became public or made a lot of money. But there's so many people along the way who don't make it. So there's something called survivorship bias. It's a very important word in entrepreneurship. And most of the time people see the success stories because the ones who are not successful, they don't make the headlines. They don't make the headlines. They're not in the press. They're not, and people like actually to see success. And it encourages people. It encourages more people to become entrepreneurs. And by the way, entrepreneurs and small and medium-sized companies everywhere in the world, I was reading even in the US, are the biggest creators of jobs. They are the engine of job creation all over the world. They're the
engine of economic contribution. I feel like they punch way above their weight. Like the amount of contribution they do to the economy, generally speaking, the ones that make it, contribute far more than the size that they start, or the VC or the venture capital market itself, or the startup market itself. It's very small, but the ones they make it, the contribution that they make in the large, economically, is much higher, don't you think?
There's definitely a huge contribution. I haven't looked at the contribution to GDP, but to employment, it's the employment creation. They are one of the biggest contributors.
Because all of those, let's say,
and that's why governments actually always like to support entrepreneurship.
Because of the entrepreneurship and because of the employment. Yes. Also, if you think about the big organizations in the world now, whoever they are, the current, even the top, I would say 10 in the S&P 500, all of them came out of the VC market, right? I mean, the Facebooks of the world, the Apples of the world, the Googles of the world, the Nvidias of the world, all of those came from the VC. They made it now to be 40% of the S&P 500.
Yes. Yeah, it's a huge concentration, but I was also studying today that this concentration in the US market is actually one of the lower, as a lot of the smaller markets all over the world have a much bigger concentration. So if you go to France or the UK, for example, the concentration in the top of the market is even bigger. But that being said, where it is very spectacular, the concentration in the US market is that it is the biggest market by such a huge margin. So for example, NVIDIA's market cap is bigger than a number of the European markets combined.
And countries' GDPs combined.
Yes.
Well,
I mean,
right?
NVIDIA is bigger than the Russell 2000, which in the US is the index of the 2,000 smallest companies which are listed. So NVIDIA alone is bigger than the entire Russell 2000.
Alone?
Alone, yes.
Is this a good thing or a bad thing from an analyst perspective?
It's actually neither good nor bad. It's a fact of economy, and it's a fact of the concentration of revenue creation and profits, and also the excitement of investors. Because companies like NVIDIA are growing their revenues and their profits very strongly. They're growing them faster than what the research analyst or the market expects. So they keep beating expectations. And that's why they keep getting valued also at numbers which some people think will be very difficult to justify in the future. But there's a lot of excitement around them, and rightfully so.
Do you think these excitements are creations of or creators of bubbles, did I say? Like the AI bubble everybody's talking about? Do you think this is an overestimation or just a normal fact of how economies, or let's say sectors, gets hyped up and then kind of regulated across time?
So bubbles are created when there's so much excitement in the market that the valuation of companies, in this case, like a stock market bubble, get ahead of the economic realities too early. So
you mean revenues?
Revenues, profits, and kind of the market cap gets to a point which is difficult to justify at a certain point in time. It doesn't mean that those companies will not actually justify those market caps at one point in the future, but you get so ahead, basically what's called getting ahead of yourself. So when you look at what happened in the dot-com bubble, a lot of the companies which were overhyped, their stock price went down, but then it went back up much higher than where it went to. And the issue is that a lot of companies also disappeared and never came back. They don't all make it. So when you get in these bubbles is also the bubble broadens beyond the top 5, 10 very high quality names which have a lot of revenue, a lot of profit, to a lot of unprofitable companies. So there are things which we're not necessarily watching here day to day, but a lot of startups with no revenues which are getting valued in the billions. So that's really, kind of the very dangerous part of the market for an investor.
So let's structure this discussion, because I love how we kind of went deep into the seas of the valuations and the kind of stock market and the hype of the AI bubble and all of that. But we started with entrepreneurs and investment banking, and you said that entrepreneurs are people who overestimate value, or let's say opportunity, and underestimate risk. And I love this definition because it's really a species of people that I don't think. Do you think it's a learned, or it's a kind of it's a nurture or nature?
I think it's more nature. I think it's more people who are naturally inclined that way, to be optimistic, to see the bright side. Risk takers. Sometimes it can be because they came from an environment where there was a lot of entrepreneurs, whether it was their families or the places where they worked. And also there is the fact that that you see other people being successful, and you get inspired, which is these are all positive things.
So it's either an ecosystem of buzz around you, people that are successful, that inspires you, or you come from a family, let's say, who from your kind of young age, you hear about entrepreneurship and risk taking, and you've had probably a couple of failures by the time you're 25 because of the support that you have with your. So it's a mix of both, but you're inclined into a nature thing. Mm-hmm. Okay. So what about investment banking? What is that?
So there's a lot of things under investment banking, and the word is very broad. So I can tell you my story. It's a good illustration. I've been in it for 32 years. I started my career with Goldman Sachs for 13 years. And in the first 7 to 10 years, I was actually a trader. I traded fixed income, government bonds. That's why in a lot of the commentary that I make and in a lot of my discussions, I'm very much a macro guy. So the part of the markets that I enjoy the most is talking about rates and inflation and foreign exchange and commodities. So the big picture. And after that, I moved, it was kind of a number of natural steps, but in the end up being, very broad. I moved from trading rates and credit to running syndications of bonds, high-grade bonds, and then emerging market bonds. So which is basically a job which is hybrid between trading and investment banking. So in that job, I helped issuers, highly rated issuers, usually governments, or semi-government entities, to issue large quantities of bonds. And over a period of 5 years, I probably was in charge of $500 billion of bond issues.
Oh, wow.
And that was with Goldman Sachs in London.
In London, okay.
In London, yes. And as part of that, I became in charge of emerging markets, and I got very excited about emerging markets. So I did deals in Abu Dhabi, in Singapore, in Korea, Turkey, all over the world in emerging market countries. And I got very excited about those. So when the firm, like all the other bulge bracket firms, started looking to open an office in Dubai. I raised my hand and I was because I really wanted to be part of that story. And I also visited Dubai in 2004 during the IMF conference,
Right.
which was really a turning point for Dubai. And I got really excited about it and haven't looked back since. I moved here in 2006. And I moved in 2007 from Goldman Sachs to Merrill Lynch. So it was at that stage, so around 20 years ago, that I started doing a lot of mergers and acquisitions as well. So normally when people say investment banking, generally they think about mergers and acquisitions. So mergers and acquisitions advise...
Structuring deals and advice,
structuring
financial
deals,
advice.
exactly.
Yeah.
Helping companies when they're selling themselves or when they're raising equity or when they're raising debt, or helping companies when they're buying other companies. And of course...
At the enterprise level.
All of that at the enterprise level. So that's really when people think about investment banking, they think about mergers and acquisitions, M&A. But the big bulge bracket banks, as we call them, so the Goldmans, the Merrills, the Bank of Americas of the world, they call themselves an investment bank, but M&A is just one department in that big mix. It's a high-profile department. It's very visible. It generates a lot of revenues. But the other departments actually generate even more revenue. So fixed income trading in particular is usually
the bonds and others.
Yes, the trading activities are usually very profitable. Of fixed income, equities, derivatives.
Is it because of the understanding of how the market cycles work, or is it because of the visibility over the macro element of the economy, or why does it generate more? Is it less sort of speculations and human beings and companies, and more on the decision making that you have visibility over?
These activities generate a lot of revenues because the volumes are so huge. So it's billions and billions of volumes happening every day. And usually the investment banks or trading divisions of the investment banks, they make a lot of relatively risk-free profits by being financial intermediaries in those transactions.
Right.
So helping institutional investors usually buy and sell securities. Bonds, stocks, derivatives, commodities, and then they get and then of course working with the capital markets and with the investment bankers, they help institutions again, go public, issue equities, issue bonds.
When you say institutions, do you mean like at level
pension
of
funds,
pension funds, endowment funds, all
exactly,
of those?
hedge funds,
right,
sovereign wealth funds. So these are the institutional investors.
In the 500 billion plus probably in value, or?
It's by value, and it's also in terms of how they're organized. And when we refer to institutions, usually it's to differentiate them from individuals. So individuals and high net worth individuals are also a big part of investment banks' kind of clients via the private banks and the wealth management.
When you say individuals, do you mean individuals or family offices, or is it two completely different things as well?
It's a good question. So individuals can be and just a single individual, or a family. They can be just a person who's opening an account, but they can also be a family which is structured as a family office. Usually it's with the amount of wealth. So the wealthier the individual or the family, the more likely they are to have a team who's helping them manage their wealth. And that's when they start being called a family office. And the family office can be a client of the private bank or of the wealth management or even asset management divisions of the investment banks or of the private banks. But they can also become large enough to be an institution and become an institutional client.
And transition from being an individual to being an institution.
Yes, it's usually it's a question of scale, of like how much money and how much sophistication we're talking about.
Do you want to give advice and handhold to make sure that they're able to do their transactions across their portfolio of assets?
Exactly. To manage their wealth, manage their risk. Just basically, make their money work for them.
Yeah.
Yes.
So let me slightly understand this, because this is way above my sort of understanding of how the capital market work, right? And I'm happy that you mentioned this, because this will allow me to kind of understand the bigger picture at a, did I say AUM level? Asset under management? Okay, so from there and then going down. So if we say you have the banks or sort of the investment banks that manage clients, and those clients are, like you said, institutions, which we said it could be universities and endowments, it could be pension funds, it could be sovereign wealth funds, it could be large.
The banks themselves are clients of the investment banks.
The banks itself, because it has its own, exactly.
Yes. So for example, Emirates NBD will have a big book of asset liabilities, to manage. It's Emirates NBD may be, I'm just taking them as an example, as the big retail bank that we all know here. They may want to structure some structured products to sell to their retail clients or the high net worth clients. And they are big clients of the investment banks.
So the retail banks are also, as one segment, is also a client of the investment banks, which is the kind of one level up.
Yes, it's not necessarily a level up or down. It's more of they are part of the economy. They're a big part of the institutional market out there, just because they have a huge balance sheets. They have they need to have assets on the asset side of their balance sheet.
Yes.
Also, when they're issuing, when they're managing their liabilities, they issue senior debt. They trade derivatives, and they go to the investment banks for help with that. So they are a client of the investment banks as well.
Okay, so all of those as customers for the investment banks and the investment bankers who have a set of talent and sort of competencies to be able to structure those deals for them. What do they do? Do they diversify their investments? What exactly what's the relationship between those? Let's talk about a pension fund, just as an example, right? A pension fund is a huge sum of money that is being worked, like you said, to make money. So that money is worked to make money. Is it about the diversification of investments? So let's say, real estate, gold, all of those asset classes. What exactly is the relationship, and what is the sort of competency that those investment bankers do to make that money make more money?
It's a great question. So there are two types, if you wish, of clients of the investment banks. Okay. One type of client is the one you're referring to, is the people who are managing assets. So we call them asset managers. It can be pension fund, sovereign fund, a mutual fund, insurance company. So anyone with a lot of assets, a lot of money to manage.
Assets could be cash, or could be assets as in like buildings and...
Yes, I'm referring to financial assets. Because financial, kind of the banks, they're really dealing with financial products such as bonds and stocks and related, derivatives and structures, private equity, public equity, private credit, public credit. So yes, so these clients will come to the banks for any, for a variety of services. These services could be the advice on which asset class to be in, but more generally, they're coming to them to execute the transactions, i.e., the bank is running an IPO, and the pension fund comes and subscribes to the IPO via the bank, or the pension fund wants to reduce, say, their exposure to the long end of the bond market. They go and sell their long-dated bonds to the investment bank, and you do something else with the cash. So the big part of the activity of the investment banks with the asset managers is really execution of transactions.
Of a decision of some sort.
Yes, and these transactions in the public markets are happening daily. On a very high frequency.
Buying and selling.
Because the markets are so huge. There's new issues all the time. In the bond market, issues are expiring all the time. So people, you're receiving dividends, you're receiving coupons, you're receiving interest, and all that needs to be reinvested. So markets never sleep. They're open 24 hours for, more than 5 days a week, and lots needs to be done.
Okay, so if let's say I'm a high net worth individual, I have, let's say, 500 million kind of worth of assets, and I come to you and I tell you, okay, I need this money to work for me. My understanding is I have an opportunity of either investing in real estate, in gold, in crypto, in PE, and by extension VC, in public markets, in whatever else. How would you conduct a conversation with me to help me understand how to diversify my asset classes and my investments in those asset classes?
Yeah, so bankers, whether they are institutional bankers like the investment bankers, or the sales people who actually look after securities, or private bankers, always when they meet a new client, the first thing they will do is assess this client's needs and risk profile.
So my needs and risk profile.
Yes.
What does that mean?
Because the suitability is a very important concept in banking.
Okay.
So when you're advising a client, you have to make sure that you're providing them with a suitable product. So just to take an extreme case, the advice you give to a an unsophisticated widow, for example,
Wow.
may be very different than the advice you give to a young entrepreneur who just sold their
Really?
business in technology.
Why so?
Because one size doesn't fit all. That's the
That I understand, but I mean, at the end of the day, I mean, financial markets, what makes money. How is that relevant to my own sort of competency and my ability to understand and comprehend the market itself?
This is a great point. First, particularly, I mean, whether you're an individual or an institution, it's important to understand what you're investing in. Nobody should invest in something if just because their banker or their friend told them this is a great investment.
Oh wow, that's an important point.
Yeah, this is very important because all investments carry risk, whether you're parking your money in cash or whether you're buying crypto, to take the two extremes of the two most risky things you can consider. Or you're investing in a money-losing startup, or you're buying the S&P 500 index, or you're buying a government bond or a credit. Everything carries risk. So hopefully the higher risk brings higher reward, but it's not always the case. And there's no guarantee of any investment being successful ever.
Successful meaning making the return that it promises.
The return that it promises, that you expect. And most investments, such as equity investments, do not promise a return. I mean, it's unknown whether the company will pay a dividend or whether the stock price will go up. Which
is the two things that makes it worthwhile.
Which is the two things that make a return. Yes.
Yes.
So the return is made of dividends and price appreciation, or in the case of a bond, in the case of a bond, the only thing you can hope for is getting your principal and your coupons. You're not going to get price appreciation.
Right.
So given that different investors, whether they are an institution or an individual, have different levels of understanding, they should invest in different things. That's why investment advisors exist.
Right, of course.
Yes, because if the same investment strategy applied to everybody, then there would be no investment advisors. It would be the same, cookie cutter.
I would say, this is how I think, or how I always evaluate the importance of certain, let's say, functions within society. First, let's say, physicians and doctors, because obviously health is everything. And teachers, of course, because this is where everything happens. But when it comes to advice, I always put investment and financial advisors up there within those, because otherwise, if your livelihood and economic kind of prosperity is not to the point where it allows you to live stress-free, then obviously all problems will just kind of open for you. So, and if you get, like you said, a bad advice that loses you everything you have without you understanding, then you won't be able to kind of comprehend why it happened, and therefore that's a bad advice. And therefore that's why it's very regulated, isn't it?
That's why it's very regulated. And the point I made, suitability, is actually a regulatory concept.
Okay.
So we investment bankers or investment advisors conduct a suitability before offering services and products to their clients, a suitability assessment.
Right.
And that's done by interviewing the person or the institution, studying what is their experience and what is their... in the case of an institution, they will have also a clear mandate. I mean, institutions will be investing usually either in bonds or in equities, either in public or in private markets. And based on that, the advisors will, make recommendations. In certain cases, in the private banking, clients can give discretionary mandate to their bankers, and the bankers will manage that money in a discretionary way based on some clear agreements and understandings. And usually when private bankers manage money in a discretionary manner, they also are quite conservative. They don't take, excessive risk. They actually follow some generally accepted, tried and tested routes, which may or may not be the best for maximizing return, but at least there's safety in number. And you may have heard of the 60-40 equities and bonds allocation. So that's a kind of a safe, old way of thinking of investing, and which has worked somewhat for many, many years.
Even if your client told you, I want to invest everything in, let's say, crypto.
No, the client can decide whatever they want, and then the advisor.
But you have to record the advice and make sure that he signs
on it.
Then
it's not. Then you're also just it's an execution function, So of course clients can decide what they want, and the advisor can give their opinion if they're asked or if they're expected to give an opinion. But at the institutional level, like these big pension funds, sovereign wealth funds, they're not really taking much advice. I mean, they are what we, in the industry, we call them big boys.
Yeah.
So they make their own decisions, and they really, I mean, of course, they listen carefully to what all these smart and well-informed people at the investment banks have to say about what their research is saying, about what they're seeing from other clients. And then the big boys take their own decisions usually.
Okay. And, is there a story in your past 30 years or 32 years where someone made a decision that you really objected, but then they went ahead with it and you were like, I told you? Did it happen before? I mean, with you or with someone you know?
Well, yes. I mean, my history has been more on the mergers and acquisitions side for the last 20 years. And there's been at least a couple of occasions where, the client who was selling their business, because typically I deal with entrepreneurs who own a business and they're selling it. There was at least a couple of cases where the seller, the client, had the choice between two buyers. And I'm not going to say what those situations were. And we recommended one, and they preferred to go with another. And we were right. And even the client told me later that they regretted their decision. But at the end of the day, they are the client. And, you are the business owner. It's your business. It's your decision. We do our best to give the best advice at all times.
If you look back now at that specific, let's say, incident, why didn't the business owner or whoever is going to make the decision at the point listen to you? What was the thing? Was it something that you were not able to explain, or was it them kind of blinded by their own whatever circumstance that they're going through?
In both cases, this is a great question. In both cases, it was because the buyers who won who managed to buy the company did an extremely good job at seducing and convincing the seller. Because usually these sellers, they're not selling the business and moving. They're actually joining the company.
Yes.
And usually there's also some elements of payment that's going to happen after the transaction based on the future performance of the business. It's called an earn-out or deferred payment.
Okay.
So
it's different than vesting, right?
It's similar to vesting.
Okay.
So you sell your business, but you get paid, let's say, 70% on day one and 30% over the next 3 years. This is a typical This is typical structure to encourage the entrepreneur to stay with the buyer.
To maintain the operations and not disrupt the business.
And also exactly. Continuity is what you mentioned, but also to perform further.
Right.
Because they can make even more money on the remaining 30%.
Yes, because now they have more resources, they have more access, and they can kind of hyperscale. Okay.
And there's alignment of interest between the buyer and the seller to grow the business. So that 30% actually improves in value relative to the initial 70%.
Of course, okay.
So in those cases, the buyers did a better job than the bankers at convincing the seller of the merits of doing the transaction with them.
Using those incentive systems that kind of lured the kind of decision maker to actually...
Yes, incentives, but also just generally they could be things that they say which may not be in writing. And usually when we're advising our clients...
Are you referring to lying?
There are cases where people may promise things and do not deliver them and that's what we tell our clients. The only thing you can rely on is what's in writing, because that's what can be enforced if the things go south in a court, in a worst case scenario. Yeah.
But you would expect people to, especially at that level of sort of now they're doing an M&A deal. That means they went through all of those sort of wars and sort of issues and nights and days of sort of grind to understand that it's, words are words.
That's right. But, when it comes to your own business, to your company, people are generally quite emotional. And particularly when they've built a business for 10, 15 or much longer than that, they're attached to it. And then numbers are numbers and contracts are contracts and what your investment, and then there's what your investment banker says, what another investment banker says, what the buyer says, and all these things, they go into the mind of the entrepreneur and they need to take a decision.
So if you go back to any of those sort of things, what would you have done differently? So the client, whether it's you or someone else as an advice to someone who's in your shoes or doing what you're doing, what would you have done differently so they actually do the right decision, which you have recommended them to do, and not make or take a decision against your advice?
I think what we could have done, and it's a very difficult thing to do, is what you just said, is highlight to the seller that the buyer may actually be misleading them. And rather than...
It's very sensitive.
It's
right?
very sensitive. So of course, as you can imagine, as bankers, we're very polished. We try to say things in a very polite, diplomatic way and keep, be very mature and professional. But when someone is very emotional, it may be also important to speak to them the language of emotion.
Of emotions as well.
Yes.
Okay. So now let's go back to the example of I am a high net worth individual. I'm looking at all of those asset classes. Now I'm looking at AI. AI is a bubble. Everybody is spending on AI. Numbers don't make sense. Spending is 1.5 trillion for a 20 million or 20 billion revenue, which doesn't make sense. It's not paying off, but I'm pushing you to I want to invest there. What would you tell me?
So, this video is going to be on the internet forever. So what I'm going to say now, we're going to look back at it, you and I, over lunch in 1 year time. And I may look, what I say may be wrong, but it's not fun if I don't say anything. So 7 December 2025.
Yes.
And
so, according to the inputs that we have, and just a digression. I heard once an economist who said, "I hate giving forecast and advice because if I'm right about the future of the economy, especially when it comes to recession and bad circumstances like the bubble. Because if I'm right, then it's a recession, it's bad. If I'm wrong, then I didn't give them the right advice, and then I'm wrong. So I'm always wrong I'm always in the kind of bad advice way. So I understand what you're saying, but giving the circumstance that we have now, and this is not an investment advice, just to be sure.
Yes, obviously this is not investment advice. And if you listen, you spend time listening to financial press or to financial forecasters, there's probably equal amount of people saying we're in a bubble and things are about to sell off, and another group of people who say things are fine. I think what's valuable for investors is to listen to some logical arguments which they can then use and adapt based on their own circumstances and view of the world. My view of the world is, as I said, bubbles are where markets get ahead of themselves, but also bubbles can inflate for an extended period of time before they pop. Okay,
inflate for an extended period of time or a specific period of time until they pop.
Yes.
What does pop mean?
Pop means that these valuations, which get way ahead of themselves, crash back to reality, or sometimes because there's a negative movement, a negative momentum, they go even below their what you would think is their fair value.
Right.
So they
go
from
the market sentiments.
Exactly, the market sentiment turns, and people who were speculating without giving it much thought,
lots of haters,
are now selling without giving it much thought, and values go below even fair value, and then it's a great opportunity for those who still have cash or who are not completely depressed to go in and scoop things cheaper. And human nature has a tendency to get very excited about crashes. So there's a lot of people who are always calling the top. Like if you go on YouTube and crash, market about to crash, you will find any day somebody who's saying today is the day,
Yes.
And my view is where we are now, we have not reached a level which is so overextended that a crash is imminent. So I don't think we're about to see much lower prices. I'm talking about US public equities, I think.
Right.
Which are dominated by these few stocks, which are all about AI, right?
Yes,
so the whole S&P 500 is really
NVIDIA, OpenAI,
driven,
Google, Microsoft.
Exactly, by those few stocks which are really pushing the price up. And by the way, that's another thing that's important, is that we're talking about a bubble in a few stocks. Yes, they make a big proportion of the market, but most of the rest of the market is quite fairly priced and quite, I would say, there is nothing very scary about it.
Individual stocks?
Yes.
What about indices?
So the big indices, which are market cap weighted, like the S&P and the NASDAQ, are usually biased towards those 10 stocks. But you can invest in something called the S&P equal weight. The ETF for that is called RSP. And in that one, all stocks have an equal weighting. And that one, its valuation, I don't have it in mind right now, it's not particularly overstretched.
Because of that
Because it's equal weighted.
Right.
You see? So most...
That's interesting.
Exactly. So most stocks like in retail or in healthcare or in manufacturing are not particularly overstretched. That's number one thing. The number two thing is, if you look at the... And people will disagree, but if you look at past crashes like in the dot-com bubble.
Yes, let's compare to that.
Exactly. Things got way more overstretched before.
More than now?
Yes, before the bubble crashed. So
you're talking about the period between 1998 and 2001?
Exactly. And what I want to say, which is something that not many people say, so I'd like to volunteer it, is the following. This overvaluation of these AI stocks, which is true. I mean, people will tell you so many interesting stories about how many hundreds of years it would take for NVIDIA to justify its future earnings and that sort of things. This situation does not necessarily require a crash to correct. The way it could correct is that the American stock market could have lower than average returns for an extended periods of time. So what I'm saying is that this year, the S&P, I think, is up around 15%. I mean, if you are a euro-based investor, that's like 7 or 8%. The S&P is actually nobody talks about that because everybody is obsessed with the S&P, yes. But it's actually one of the weakest stock markets in the world. And we're sitting here talking about it being in a bubble. The emerging market aggregate index is up more than 30%. Japan is up close to 30%.
You're talking about relative.
Yes, on a relative basis to the rest of the world, the US market has not performed in a hyperbolic way. It hasn't gone up 60% like gold has. In gold terms, the S&P is down. If you were to price the S&P in gold, actually, most stock markets are down if you price them in gold, right?
In terms of, and relative to gold, because of how fast goes.
Because gold has been going hyperbolically up, but that's not the case with the aggregate S&P or Nasdaq. And there's been some very good research by my friends at Goldman Sachs, who say, given where the valuations are now, if you buy the market now, you should expect the return to be around 2-3% in real terms, which is 2-3% plus inflation. Maybe you make around 5% for the next 10 years. That's what history tells us.
If you buy today?
Yes.
That's not a loss. That's good.
It's not a loss. It's still up a little bit, but you're better off buying the 30-year government bond, right, and you make as of today 4.8%. Risk-free, because the US government will not default. They're going to print dollars.
Of course, yeah.
And you're going to get that 4.8%. So it's a risk to own the S&P.
So that's discounted, that 5% of the stock market? Because when you discount the future value of money, that's how the percentage is calculated? So
if the market reverts, which it does over a long period of time, to an average valuation...
But how about the stock market?
The stock market, the US stock market, the S&P specifically, then you will earn roughly 5% for the next 10 years.
Okay.
Now that 5%, given we're up 15%, this year you could see a year where you're down 5%, another year where you're up 10%, a year where you're flat.
To average at?
That's my view. Actually, my view is, which is not investment, is that the S&P is going to continue to have a mediocre performance. Because 15% is a mediocre performance. I think emerging markets are going to have an amazing performance this year.
You mean mediocre relative to?
Relative to other options that you have. Yes, exactly.
So, okay, then all of those pundits that are talking about how the bubble is just a bubble and it's going to crash and it's a .com, is this just media talk?
No, all these pundits are talking about it because it's by far the biggest market in the world. As we said, NVIDIA alone is bigger than France and Germany's stock markets.
4 trillion or 5 trillion?
Exactly. So it's so big. And so it's roughly 60, depending what you look at, around 60 to 70% of the entire world stock market capitalizations. So it's worthwhile talking about it. It's not like, why are we sitting here in Dubai talking about the S&P, right? It's huge. It's a huge part of what our sovereign wealth funds are investing in, what our banks are investing in. If you have an insurance life insurance contract, your insurance company is investing in it. So it's not an irrelevant discussion. It is a relevant discussion. And so people worry a lot whether it's going to be up 5% or flat or it's going to crash.
As NVIDIA.
As the S&P.
As the S&P,
Yes,
okay.
yes.
But it's driven by the hype that AI is creating, which is obviously as an infrastructure, NVIDIA is creating, right? But the thing that I'm trying to wrap my head around is, and this is where probably you'll be able to help me understand, is when you do these things, you do these things based on value that is being created. For example, gold is gold. I mean, it's the eternal sort of value stored in that sort of shiny object that people will eternally, forever, kind of value it at this way. It goes up and down, but still it has some sort of a value, and that's kind of unanimous. When it comes to NVIDIA, it's not software, it's still hardware, but that hardware is amortized and depreciated now because technology is kind of fast-tracked. So whatever chips they're creating, it can be obsolete in, let's say, 18 months. So how does that relate to the valuation that's happening? And if someone else comes in to the picture, like, for example, another company that does that now, Google is kind of doing the TPU and others. How does that affect my livelihood if I have investments there, whether myself or my institutions or my country or otherwise? Because like you said, it is substantial. It is affecting everyone. And if it crashed, all of my investments, whether directly or indirectly, will affect, and my livelihood will affect. So to your point, it is relevant to a discussion. So how would that sort of volatility, can I say, of the value will impact my or that sort of valuation?
Yeah, it's a beautiful word, uses the volatility of the value. There's a lot of risk in these things. I mean, today NVIDIA is making 80% of the chips. Tomorrow Google is in, and maybe NVIDIA will make only 50% of the chips.
And China now is just marching ahead.
And what guarantee do we have that someone in Europe or in China or in Korea is not suddenly going to have a breakthrough? So, I mean, we're dealing with nascent technologies. In one of the most interesting arguments I've heard is that the advances in AI itself could lead to some much smarter ways of developing data centers, of developing AI itself. So AI itself may tell us, guess what? All these trillions were not needed. And here's we could have like another DeepSeek moment. Right?
Yes, that's exactly what I'm...
It is incredibly risky. And I just admire, the appetite of investors, particularly American investors, who they love taking risks, they love innovation, they have this kind of entrepreneurial enthusiasm. It is a very risky...
That discussion is not still stopping them from actually pursuing that. With that risk, it's not discounting it to zero.
Yes.
It's discounting it a little bit, but still they're able to kind of
maybe if we can segue from that into something that's a very important topic for me, is what also drives all this is beyond the math and the number and the risk appetite is liquidity. The amount of liquidity in the world is huge. And that's because governments...
You mean cash?
Cash. Because governments all over the world are printing money all the time.
That's fiat, isn't it?
Exactly. So everything we're talking about is the price of stocks in US dollars or in euros or in Japanese yen. So we are the unit of measurement is really flows the conversation.
Yes.
Because if you were trying to measure everything in gold, for example, or even in Bitcoin, it would be a very different, very, very different story. I mean, if you tried, the fact that they're printing all this money is very important, and it pollutes the analysis.
Yes.
Because you're looking at future cash flows in dollars. And the Fed, it just ended quantitative tightening. It's about to start quantitative easing. It's going to cut rates. Many people like myself think they're going to cut rates even more than what the market expects, which is going to make liquidity even more abundant and financing even more available.
But that's not a good thing, is it? I mean, I know that thing will be there, but now US and the dollar is not the center of value anymore. So when an alternative is there, be it the BRICS, nations, be it the kind of global south everybody's talking about, be it gold now and what China is doing, how is abundance of dollar going to affect the value stored in dollar, which is fiat, and it's not actual? I mean, it's, if you and I agree to it, then it's fine, but it doesn't have a store of value, isn't it?
So you make two very important points, which I really want to address. The first one is, it's not just the Fed that's printing money. The Japanese have been printing money for a long time. The Chinese are printing money, the Europeans, and most emerging market countries as well. So The fiat debasement is not a dollar debasement. If anything, I mean, the Americans are kind of the ones who kept orthodoxy the longest. I mean, I carry a French passport. I mean, the French have been very bad with deficits and excessive spending and lack of fiscal discipline for much longer, right? And the Japanese have 225%, debt to GDP. So again, we talk a lot about it in the context of the dollar and of the US, because their debt to GDP just went above 100, which is a very bad level. And I think they are entering what Besant and Trump call the spiral of death, which is a very negative spiral of debt. That's why we're talking about it. But they are not the standouts. They are more in line with everyone else. So fiat, all currencies which are controlled by governments are being debased. The other point you made, which is like a very word that's very dear to my heart, you use the word good. You said this is not good. Now, we're talking about finance and investing and making money. So we're not necessarily talking about ethics. But if I may speak about what's good. Mm-hmm. And it's a very utopian thing. And I've never said this, online before so clearly, but just to be clear, and I'm very happy to be saying it with you today, Usama. I think what's good, if you want to have an ethical monetary system, you need to have hard money. You need to have a currency that cannot be printed by the government. And for most of humanity, we have had hard money. We've had, in the old days, we used to have gold and silver. And that's hard money. And then until 1914, we had currencies which were linked to gold. And it was precisely in 1914, when World War I started, that the majority of countries, the developed countries like France, Germany, the UK, and the US, the richest countries in the world at the time, they decided to abandon the peg to gold. Why? Because you cannot finance a war and kill millions of people if you have hard money. Because if you have hard money, the war will not last very long, because people will refuse to pay taxes to a government who is engaging in a war which results in millions of deaths. Nothing is worth the deaths that happened in between 1914, 1918, 1939, 1945, and ever since then, everywhere in the world, whether it's in Gaza or in Ukraine or in Lebanon, or every war. Has anyone looked back and said, well, that was a good war? I'm glad those 10 million people died. That is not good. Nobody wants war. I call war, because you said good, I'll tell you what's good. War is borrowing money from the future generations to kill the current generations. That's what war is. War only exists because governments can borrow money. Because no government can tax their way to war. And that's why in 1914, when the two parties, France and Germany, said, listen, nobody wanted to surrender, basically, they started printing money. And that money printing led to the 1930s hyperinflation in Germany, and then to World War II again. And
that's a lot to unpack. And
there is this is for another discussion. And I would be happy if you interview me, but there's better people to interview on this. I invite you to read the book by Saifeddin Ammous, which is called The Bitcoin Standard. And he explains very clearly, and he gives you numerous examples of how the good in humanity happened under hard money. Bach and Mozart and Jean-Jacques Rousseau and the greatest inventions such as electricity and the telephone and the airplane all happened under hard money.
Because you have to have real value to be able to print money. Otherwise, you're just centralizing the value with a few people who can print and then buy their way into their own desires. Is this what you're trying to say?
It is along these lines. It is basically the fact that when you have hard money, you have to take, you become much more cautious at what you do with your time and with your money.
Because you don't control the value creation, let's say, because the value is as you said, is pegged to gold. So you have, it's the scarcity theory.
The scarcity. So money has real value.
Yes.
Today, so many people make more money from their investments or from their savings that they make even from their own jobs. Why? It's because governments are inflating the value of assets. This is why you have so much social unrest all over in the developed world. 40, 50, 60% of Americans are living hand to mouth. Americans.
And the biggest economy in the world.
Exactly. While the top 10% are consuming 50% of the consumption is done by the top 10%. And an even bigger concentration of the wealth ownership is with the top 5% and the top 1%. And that would not happen without the printing of money that the governments have done.
And it won't happen without wars, because you have to back that value with government stability and power and strength, isn't it? I mean, if I kind of draw a parallel to this, we have two examples to mind, and I would love to hear your thoughts on this, which is Lebanon and Venezuela. The currency crashed, but they don't have a government to back that with the rest of the world. US has military, the West has military, has power, has sort of other elements to back their own printing of money and force people to recognize that value. Is my understanding correct?
That's a good point, yes. So if you are in Lebanon or in Egypt, and there's an amazing word we use, which is hard currency. We say the dollar is hard currency. We say this is a good Egyptian company. It doesn't rely on revenue in Egyptian pounds. It has its revenue in hard currency. Why do we call the dollar a hard currency? It's an allusion to hard money, when money used to be metallic gold and silver. So when you are in a country which is experiencing hyperinflation, whether it's now or from time to time, like Lebanon, Egypt, Turkey, the dollar, which has a much lower rate of inflation, becomes a hard currency. It's just because exactly what you said, the Americans are running their economy. It's much better. Their production capacity, their military power, the fact that they have the reserve currency of the world means that their currency is actually getting debased less than all the other currencies. Right? So all the talk now about dollar debasement or dollar devaluation is a new talk, because we're talking about the most important currency in the world, that the one that the rest of the world used to consider as the reserve currency being at risk.
That's the actual store of value compared to all of the other currencies.
I mean, that is relatively new, but in reality, even the dollar, when you compare it to gold, has lost 99% of its value since, I think, 1930. 99%.
So how do you comment on China's efforts to store gold now and have the gold corridor, and kind of, because it's the main reason, as per my understanding, for the inflation of gold, because of how much they're doing. And I know that multiple countries around the world are doing it, but China is the one mostly vocal about it. Is it because they're going into that, kind of going back into the kind of steel, or let's say gold element as store of value?
It's a great question, and it's political. And I will talk.
Let's talk economy.
I will talk about the political aspects of it from a finance and business perspective, because it would be wrong not to.
It has to be in context,
exactly, not to mention that. So China and the US have a sort of conflict. It's not an armed conflict. It's a conflict for supremacy in technology,
dominance,
influence. I mean, it's a normal thing which happens, and as long as countries are not killing humans, and they can be in conflict. It can be trade wars. We use the word war. I mean, as long as it's a commercial war, it's a war for monetary supremacy, technological supremacy, innovation. It can be good. Competition actually can be good for innovation.
100%.
Exactly. So it's that's what we call a multipolar world, a world which is not dominated by a single power. Okay, so
you're using the word good here intentionally, right? The ethical good. Like, yes, we need to have competition to be able to grow and develop, as long as it's actual good, which is not killing human beings and engaging in wars, right?
Yes. I mean, of course, these wars, they come at cost, social costs, etc., which are not good. But I'm going back to your question about gold.
Yes.
So what happened with gold was also political, because there's two things that drive asset prices. One thing is the fundamental value of an asset.
Yeah.
And the other is flows. Are people buying it or are people selling it?
Yes.
Yeah. And
so you're talking about intrinsic value versus extrinsic value, so to speak.
Yes, I'm talking about the actual price. What is it really the result of? Is how many buyers there are versus how many sellers? And if you want, I can comment on Bitcoin after gold.
Yes, okay. I would. Yeah,
which I'm sure the audience would enjoy. So the reason we've had an amazing run in gold was very specifically linked to flows. When Russia invaded Ukraine, the Europeans and the Americans did sanctions against the Russians, which included expropriating or freezing some of their assets outside of Russia.
Right.
So these are assets which they had in euros or in dollars.
Yes, I know that.
Yeah. And as part of what the Europeans...
Which has shaken trust in those type of dealings and relationships.
Exactly. So because...
If I don't like you, I'll just not give you what
exactly. I mean,
I owe you.
This is not an ethical judgment
no.
on either the Russians or the Europeans or the Americans.
That's a fact. That happens.
The only ethical judgment I have is that war is horrible and Russia should never have invaded Ukraine and people should not be dying because, leaders want to have more land or whatever, But the fact is, as part of their defense of Ukraine or war with Russia, the Europeans and the Americans froze the assets of the Russians. Okay. Now, when you look at that, and you are another emerging market country, such as China, India, any country in the world which has maybe good, bad, average, neutral relations with the US, you gotta think.
Well, you have assets there.
You have to think to yourself that you own trillions of US treasuries and European government bonds. It is your duty to think, what do I want to be a hostage to this nation, which could overnight, whether I provoke them or not, decide to freeze my assets? The Americans can decide to not pay interest on their US treasuries to selected people. It's called the selective default. It's been discussed in the press. It's been considered as a weapon in the trade war. So if you are a sovereign and who has a huge proportion of their, it's called the external reserves of the central bank in US treasuries, it is your duty to reduce that exposure because it's not a theoretical risk. They just did it to the Russians. I think they may have done it I'm sure they've done it to other smaller countries. I think in the past they had done it to some, I'm sure they've done it to Iran and Korea.
Right.
So in the past they used to do it to small rogue players,
nations,
people who didn't, who could not retaliate. Right. But if you're China or Russia or some countries in Africa, it is your duty to diversify away from those assets, whether they're bonds, equities, which could be seized. Of course, the best thing you can do is maintain good relations, and so nobody wants to seize your assets. But given it's a risk, look at other things, diversification, invest in other countries, invest at home, keep your money at home, and of course gold. Because gold has been for thousands and thousands of years a great store of value, and of course, and this is where I want to kind of link it a little bit more to the broader things the Chinese are trying to do. So as the Chinese accumulate more and more gold, it does create more trust and more faith in their currency, the Chinese yuan currency. Okay.
Until it's pegged to the gold or before?
So no currencies currently, as far as I know, are really pegged to gold. But the US has the biggest stock of gold, and it's part of why the US dollar is considered the reserve currency. Now, the amount of currency that they've printed relative to their stock of gold, that is the debasement.
Right.
All right. So if your currency was backed 1-for-1 with gold, then your currency would be as good as gold. If you maintain, if the currency is a promise to deliver to you gold, which it used to be until 1914, and for Switzerland 1938.
The currency was like a how do I say it, a bond or some sort of a paper to say, okay, give me my gold back. Here's a promise that I have a gold. Yeah.
So at different points in history, that promise was more or less solid. Until 1914, it was pretty much solid. Switzerland, 1938, that's why the Swiss franc is the strongest currency in the world. And then after the war, there was a sort of a soft linkage to gold, which was the US had a lot of gold. Even some European countries put their gold in the US. And in exchange of that, they took dollars as a reserve assets instead of having gold in their vaults. So there was an implicit linkage of the dollar to gold until 1979. And that linkage has gone. And since then, they've accelerated the printing of dollars, which means the dollar is less and less linked to gold. So what the Chinese now are doing, they're trying to do the opposite.
Yes.
They're trying to tell the world, particularly other emerging markets, look at us, we are buying so much gold. I don't know where they are. I mean, the Chinese are coming from a very low base as well, so that's important. The Chinese in their...
Low base as in the difference between how much gold they have and how much currency they have.
Relative to the size of their economy, their gold holdings are much lower than some of the European and the
takes
US.
Physical amount of effort and time that you have to actually move these kind of blocks of like physical gold and store them in vaults.
Yes. So I just want to...
It's not like it's a mouse click that you transfer from one bank to the other.
And
right?
in the process, I mean, gold is up 100% since they started buying. And it's likely to continue to go up because so
their buying power also gets weakened by time because of that increase of the price of the gold itself. If they're doing it ethically, of course, if they're not stealing it.
Yes, no, I mean, this is a good point. They are, of course, I mean, you have to buy it. You cannot print gold. That's the beauty. That's why gold has kind of ethical value to it. The one thing that they've been accused of doing is not telling us how much they're buying. So they disclose some amount of buying, but people in the market say that they actually own or they're buying secretly more gold.
Why would they do that?
To reduce the impact on price, because the problem is when you're buying such large amounts, you're moving the price. Part of the Chinese story is to actually tell the world that they're so powerful.
Because they want to have that confidence and trust.
Because they want counterparties to trade with them in the yuan, to weaken the US, and also so they don't rely on the yuan. So because if you don't want to hold dollars, well, how are you going to trade goods, commodities, etc.? You're telling people, use my currency, and people are going to say, well, your currency is being debased, it's being devalued, and then the answer is, look at how much gold I have.
Yes. Yeah. But you have to declare it. I mean,
exactly. It's a bit of a catch-27. So they need to say that they have a lot of gold, which to give more confidence to their trading partners. Exactly. And that's why Trump spoke of doing an audit of Fort Knox and showing the gold, and there's a bit of controversy around that. I don't know why.
So do you see that the world will go back into the quote-unquote gold standard? Let's answer the question in two terms or two ways. Is it even possible, and will it happen? So let's start with, is it possible?
Yes. So when you look at history, the majority of the time, I'm talking history since the Egyptians and the Romans.
Yes.
The majority of the time, as a percentage of the number of years, we've had hard currency. Okay?
Gold.
Which is
gold and silver.
We started with other things like seashells and copper, and people used rocks, etc. It's important to understand actually that people tried different things. It wasn't like gold from day one, you know.
Right.
So there's an evolution.
The historical store of value that people agree to exchange goods.
So not just a store of value; it's a unit of exchange.
Unit of exchange. Yes.
That's what makes it money. So why do we even need money? It's because as societies develop, and not all living in the same village, you want to exchange, I make jackets, you make shoes. There's only so much bartering of jackets versus shoes we can do, right? So we need a unit of exchange, and we're going to use something. That something, it's called money. You need it to have three characteristics. You need it to be able to easily travel through space, i.e., so it has to be very dense, so it's easy to carry it. You need it to be able to divide it into small pieces. So I don't want to only buy shoes. I may want to buy laces. I want to buy shoe cream, And the most important thing, you need to be able to travel through time. So if you have money now that can buy you a pair of shoes, you don't want to wake up in 2 years' time and the same money cannot buy you a pair of shoes.
It's valueless.
You don't want money that loses its value over time. You need money that keeps its value. And that's gold.
Okay, so you can carry it. It's divisible, so
and it travels through time.
It travels through time, so you can carry it, meaning physically you can have it in your pocket or whatever. It's divisible. So, for example, if I want to buy a piece of very cheap thing and a piece of very expensive thing, it can't be with the same amount of money. Otherwise, the kind of exchange is unfair, and it needs to maintain its value, relatively speaking, across a longer period of time. Interesting.
Absolutely. Okay. And that carrying of its value across time is the most important characteristic of money.
Money, yes.
Because then it's money that you can trust.
Yes.
Like if you've lived in a country with hyperinflation like Egypt, Lebanon, or Turkey, people, when they get money, they're nervous. They want to buy something with it. While in the
Because
days,
they know in a few months' time, probably that money will not buy them that thing.
yeah, while in the old days, if you had gold, you had your gold. You put it in the safe, you put it in your vault, and you know that the gold that can buy you a horse today will be able to buy you a horse in 10 years' time. And you look at certain things like that existed since antiquity, such as the salary of a general in the army.
Right.
In gold, today it's still the same as a general in the US Army or in the drone
No
army.
way.
Same salary in
Oh,
gold.
wow.
Or if you look in maybe more like in recent history.
In absolute value.
Yeah,
maybe.
or the price of a Ferrari or a Rolex, something that has like identifiable value for the last 50 years, it's probably more or less the same in gold. Yeah?
Oh, wow.
And so that's the ability of money to carry its value through time. While the US dollar, as I said, over the last 100 years is down 99%. So literally it can buy 100 times less than what it was able to buy at the time. And that's the definition of hard money. So just to go back, so in history, generally we lived with hard money. Through certain periods, which particularly the last 50 years, we've been in a period of soft money, fiat money. Now I have bad news for you. When you study history, whether it was the Roman Empire or what happened in 1914, or usually, or what happened in 1939, more specifically.
The Great Depression?
The period of fiat money ends in a form of massive upheaval, revolution,
social unrest,
war. Some think catastrophic happens, which makes people realize they need to go back to hard money. And that's why after the World War II, they went back to a sort of form of gold linkage and with the Bretton Woods Accords.
Yeah.
Because World War II specifically was driven by the hyperinflation in Germany. The Germans were so poor, they were so unhappy. That's why they elected Hitler. I mean, he didn't come out of nowhere. They brought him. They wanted this very strong leader who promised them to solve their problems.
Because it's all about fear mongering. If someone is able to talk to the emotions of the people and they're super emotional, they won't listen to reason, and they will elect the best orator, let's say, someone who's able to...
Someone who listens to the people. Because the people
speaks their
are...
language.
Exactly, because the people are tired of being poor, of not being able to make ends meet. I mean, you've seen these pictures of people in Germany carrying barrels of money to go buy bread. So that's how it ends. Unfortunately, that's how it ends. Now, I hope we're not going to have an actual war with millions of deaths. I would argue that we are already in that phase because there is a form of, there's a lot of wars all over the world. There's even a form of, I would call it, some people are calling it a cold civil war in the US.
Right.
Where the federal government is up against the states, people of different colors and races are against, exactly. People who were born it's a country of immigrants, and the people who were born here are against the people who arrived 10 years ago. People who live on the coast are against the people who live in the middle. So there is a form of that social civil war, in a cold way. So like a cold civil war. So it is already happening to some extent. And maybe that does lead us to some form of hard money being reintroduced.
Or else the consequences will be catastrophic.
Yeah, I mean, I hope it just doesn't deteriorate
no one does,
to a point where there's a lot of horrible things.
I don't want to kind of go deeper into this, but just to kind of understand the rationale behind the kind of theories that are obviously, history can tell us if it's true, is because of that 60 to 70% hand-to-mouth kind of economy of the population of the US, and therefore they'll always be at the edge, therefore they'll always ask for change, therefore it will lead to all of these kind of civil unrests and social sort of chaos, right?
Yes,
because of that sort of economic weak economy that makes people the money that they make is not enough for their livelihood or their lifestyle.
Exactly. There is a big affordability crisis. So, when you ask people anywhere in the world, but particularly in the US, what is their biggest pain point is that they cannot afford things. I mean, the prices of meat, for example, are up a tremendous amount. The chart of meat in the steaks in the US looks like gold.
Oh, wow.
Yeah. So there's a number of things that are very making people's lives very difficult. And this is it's the accumulated inflation over the last few years.
Okay, so you said that it's possible that gold can be the gold standard again.
Yes, so it's possible that it can be gold, and what's important is, for a standard to be a gold standard is that it's widely accepted. By usually it's beyond a single country.
Yes,
it could start in a single country.
But gold is accepted as a store of value, isn't it?
As a store of value, but not as money. So if you cannot go to the supermarket and buy something with gold.
No, of course not. I mean, this is where what I'm trying to say here is instead of fiat, gold standard, right?
Yes.
So turn back from fiat to gold standard. So you still have the same money. So for example, you have enough gold to kind of support, let's say, 50% of the dollar in the world, circulating in the world. So this is what you said, what did you call it? The deficit? Or
the debasement.
The debasement.
Yes.
So that's 50%. So which means I stop printing money and I start adding more gold to reach to that kind of level of money circulating.
Yes, or one of the theories that's circulating is because, the US has their gold priced on their balance sheet at some ancient price. I don't know if it's $40 or $100. Some very.
It doesn't follow the gold price?
It's not in the budget of the United States of America. It's marked at the original, some very old price, right?
Okay.
So one of the theories is that the Americans could revalue their gold at a price which could be the current price, or it could be much higher.
They could do that, but they
can do whatever they want because
that's meaningless, isn't it?
No,
because like you said, it has to be agreed by everyone.
It's the US, and they're pricing gold in dollars and dollar in gold. So let's put it this way: let's say they price it at the current price, then nothing happens. Everybody will come to them and say, "Will you sell us some of the gold at the current price, or will you buy my gold at the price?" And the Americans will say, "Yes, we can buy and sell at the current price." Current price is around 4,300. But some of the theories that are out there, and just to kind of provoke the imagination of people listening to the podcast, is theories that the Americans come up and say, "You know what? We're going to price it at $40,000 per ounce." Okay, and what does that really mean is that they've devalued the dollar.
Yes.
To 40,000 per ounce. So I mean, if they say it's 40,000, that means they will buy unlimited amount of golds at 40,000. They cannot just put it on their. They cannot just. It's not an accounting treatment. They're
it's
saying
not a spreadsheet thing. It's actual.
We will buy your gold at 40,000. We will print. They can, because they can print dollars. This is how you do it.
Oh wow! Okay.
Exactly.
So, what's the impact on, let's say, the economy if they do that and try to kind of close that gap between the amount of gold they have in their vaults and the amount of dollars, and then reach to a point where, you know what, it's 1-to-1 again?
The impact is, I mean, it's quite a shock to the system, because the purchasing power of dollars drops significantly if you devalue them by 10x overnight, as opposed to letting it happen over a long period of time. So that's really the question. Yeah.
Okay. So, let's go back to kind of here, and because we talked about valuation and store of value and sort of all of these elements that kind of govern the interaction or the economic exchange between two parties, whether it's me buying, me having chicken and you have a cow, so I give you 10 chickens instead of a cow.
That's why we need money.
Exactly. All the way to everything in between. Now, we go back, I'm the high net worth individual. I have all of those kind of asset classes. I have gold, crypto. Do you think I should buy crypto? And does it have the same value of scarcity and kind of common, let's say, exchange as gold?
So I will make only one comment, because I think we have a lot of other things we want to cover. And I said I want to talk only about Bitcoin.
Yeah.
Because I spoke about money. So the way we define money is something that is, it can travel across. Let's take the definitions of money and see how Bitcoin fits that definition. Can it travel across space easily? Of course. I can move it from this end to the world to the other end instantly.
Yeah.
Can it travel across time easily, i.e. keep its value? Well, the definition of that, just to be clear, it's not about because we're talking about day to day, we talk about the price of Bitcoin in dollars, and people say it's up thousands of percent and all that. And that's it. I'll come back to that issue of the volatility of the price of Bitcoin in a second. But talking about, is Bitcoin fitting the definition of hard money, the answer is as follows. To travel well across time, a money has to have the highest stock to flow ratio possible. What's stock to flow? The amount of that money that is available in the world has to be very high relative to the amount that's being created or mined every year. Because gold has been around for so long, the stock of gold that's above the earth is so huge that the amount of mining that's happening every year is around 2 to 3%, depending on which source.
Yeah.
So that's why gold is currently, or has been, the hardest form of money. So if you look at silver, that stock to flow ratio is around 5 times less than gold. And that's why the price of silver to gold follows that ratio.
Gotcha.
Which is the mining, there's more silver being mined. That's why silver is less valuable per ounce than gold.
Which goes into the scarcity concept.
It's exactly the point of scarcity.
Yeah.
The way Bitcoin was designed was exactly to be the perfect hard money.
That you can mine quickly in the beginning, but then it slows down.
And then every 4 years, you get half as much. And by now, I think 90 or 95% of all Bitcoins have been mined.
It's much harder to mine now.
So the stock to flow of Bitcoin is already very good, and it's only going to get better. So Bitcoin's stock to flow is already beating gold. And the last one is the fact that you can divide it into very small amount. Yes. Well, we know that Bitcoin can be divided into 100 million satoshis.
Yes.
So Bitcoin is the hardest form of money on paper. And actually, Bitcoin is being used to make payments.
Transactions,
nobody uses gold these days to make payments, but it's already being used. But that adoption is still in its early days. So what I want to say about Bitcoin is it's very important to understand that Bitcoin is money. Just like gold was money. So Bitcoin is the best form of money for the digital age. Now, if the world were to move to a hard money standard, it could use gold, it could use Bitcoin. Maybe some countries, because of the politics, will use gold and others will use Bitcoin. So there is a political element there as well.
Right.
Yeah. There is an element which is that Bitcoin is a massive disruptor for the financial institutions because you can pay, you can hold your money and you can pay with it without using a bank. So it's a threat to
the business model of the bank itself.
To the business model of financial institutions all over the world. It's a huge threat. So there is a huge...
All of those top line revenues that you're making from all of those transactions just
There's
vanished.
A huge industry which is threatened by Bitcoin.
Like the horse carriage back in the days when the cars came in. It's just completely ignored and bypassed to conduct whatever you want to conduct.
Exactly. And hence there's also a huge volatility because if Bitcoin becomes money, the ultimate money adopted by many countries around the world, many individuals around the world, which is happening, then the price in Bitcoin in dollars does not matter. But you could also imagine that the price of dollars in Bitcoin will go down to infinity.
Yes.
Because
no one will care about dollar, and everybody will care about...
because there is this death spiral that the US government is describing, which is like they print more and more dollars to pay down their debt. Less and less people are interested in holding their debt, so the value of their fiat currency goes down to infinity. When priced in hard currencies such as gold and Bitcoin. Now I don't know which one will win, and this is a very long-term view. Yeah. Some people believe this will happen in our lifetime, given the speed. Because it is happening at a very high speed.
Yeah, and I think discussing it is only discussing speculations. There's no real science behind it. And we can go on and on and on about gold versus Bitcoin or whatever two stores of value.
Yeah.
So if I go back now to me being a high net worth individual, you told me about gold, the traditional things, bonds, real estate, VC, or let's say venture capital, which is under PE. Now, if I buy something, let's say I want to buy these glasses, and I go to a store, and I ask for, okay, I want to buy this. How much will you, give it to me? And he tells me, I will give you these glasses for $10 million. I'll giggle. I'll tell him, thank you, have a nice life, and I'll leave. Because obviously the value of this, I will never accept being $10 million. The same concept in my mind, and this is what I need you to kind of help me understand, is with ventures. I am now creating a business. And this business is obviously coming from nothing. Let's say when I created this, it came from, let's say, raw materials, whatever, sand and something that doesn't have any value. But then I got it, created something that I value, and then this has value that I accept. So if you tell me that this is 4,000 dirhams, I'll tell you, fine, okay, this is good. I'll take it. Businesses in the same thing. So you take raw materials vis-a-vis people's smarts, effort, time, and sometimes other ingredients that you put together to create that startup or that venture. But then you keep on working on it to a point that then I come to me as a high net worth individual and say, hey, would you buy 20% of that? And I say, okay, 20%, how much do you want? And I say, okay, give me $1 million. That by definition gives a value to my startup.
Of 5 million.
Of 5 million, right? Now, in the same concept that I didn't accept this for $5 million or $10 million, what makes me, because I use this, I understand it. So I put it on, I look at it, I compare it with others. I'm happy with the, let's say, 4,000 dirhams worth of glasses. As an investor or as someone who has money, how will I look at this startup and actually agree that, oh, you know what, that's a good price, 1 million for 20%. I'll buy it. What should I do?
No, great topic. I mean, the topic of valuation of companies in general and early stage companies in particular. So in my company now, for the last 10 years after Merrill Lynch and all that, Awad Capital, we work with business owners.
To help them answer this question.
Help them answer this question. And we actually, not many people know that we actually do valuations of companies as a service for a fee. But the main thing that we do, the majority of what we do, I was running the statistics, I think 60-70%, is we help business owners, VCs, private equity funds, when they're selling their companies. We also help them when they're raising equity capital. And they also help people who are buying companies. So, but at the heart of all these services, whether you're valuing a company, selling a company, or buying a company, is you need to know the value of company, valuations of companies. And that valuation is, there's different methodologies, depending on the stage of the company, as well as the industry. But at the end of the day, you need to go to some principles, which are that the fundamental principle is that an investor invests their money and they expect a return. And that return is going to be either in the form of dividends or somebody buying those shares. And that return, which is the sum of the cash flows and the price, has to justify the risk. So the more matured, so if I'm buying an industrial company, which is...
It has land, pieces, let's say factories, yeah.
Or it has infrastructure, it has very predictable cash. If I invest in SALIC, that's an extreme case, it's almost like a bond. So it's
almost like, yes.
Exactly. So some companies are so safe, their cash flows are so predictable that they're similar to a bond, which is the promise of coupons and principal.
Yes, in the future.
And some companies are so risky and there's so much uncertainty around them that they are much more difficult to value.
Yeah.
And the price can go up and down a lot or vary a lot depending on different things.
Which makes my return on investment
more uncertain.
Exactly.
Much more uncertain, right.
From an investor perspective, that's not good. Not in an ethical good, that's not good as a decision to make.
Exactly.
And I need to be more careful.
That's more risky. That's why it's called venture capital.
Yes.
It's in Arabic, the word used is literally the word danger.
Danger, yes.
Yeah,
yes,
what
yes.
is it? It's استثمار الخطير.
Khatir, yes.
So it's dangerous investment in Arabic, yes.
Correct.
Yeah, by the way, just because we're talking about history, the word venture capital started with bankers who were financing traders who were taking cargo over the seas. And that was the venture. So taking a cargo overseas was very risky.
Yes, of course.
Because of piracy, weather. And that was how the word venture capital came from in the old days. So it was, they were not bankers, they were financiers who were willing to take a lot of risk because the normal bankers would not take that risk.
Interesting.
Hence the venture capital industry exists because it's not something bankers or private equity or traditional investors were willing to do. And it
goes back down to the valuation of that thing.
Because it's so uncertain. I mean, the success is uncertain, right? So that the way a venture capital portfolio is constructed is with the expectation that maybe half the companies will not survive.
Yes.
And maybe 30-40% will return their money, and only 1 or 2 will be superstars.
Will make the power curve. Yeah.
Yes. So it's a risky investment because of the uncertainty of the outcomes. Now, how do we value those companies? Well, it's a bit more difficult. It's a bit more of a guessing game. But I think it's easier to maybe if we talk about how we value mature companies, and then from that we can work backwards.
Yes.
To how to value early stage and immature companies, right? So it's just the company whose profile is similar to a bond can be valued like a bond. And this is where the DCF comes from, right? Because in the DCF, you have a series of cash flows and a terminal value, which you discount at a discount rate.
A predicted cash flow.
Predicted, yes. Exactly.
And then a terminal value at whatever exit horizon you want to kind of make. Okay.
Yeah. So for a company which cash flows and terminal value, for example, if it's a factory, you know roughly where you can sell that
There's
factory.
A manufacturing belt, there's market, that kind of predictable buying power.
So the DCF is a very good predictor of the value of such companies.
Agreed.
And then you go into companies which have more uncertainty. For example, the Mac 7, there's uncertainty which technology will win, which type of chips will be most utilized, will all this capex be remunerated appropriately or not? So investors do a lot of research and a lot of calculations to try and best estimate the value. I think one very good way I've seen from a VC when we were discussing the valuation of a company at the earliest, at the not necessarily early stage, at the mid stage, we were trying to market a company.
What's mid stage?
Say, Series B, C, the company has revenues.
So it had revenue, there's EBITDA, positive EBITDA, there's profit, cash
flow. Or maybe
flow.
barely positive, just approaching positivity.
But there's enough traction to allow you to kind of predict.
Yes,
okay.
yes.
Okay.
So it's important to think backwards from how the mature companies are priced, because as a venture capitalist or as an early stage or as a mid-stage investor, you need to have scenarios when you go to your investment committee about who's going to buy this company from me. So you're buying a company which does not have revenues. By the time it has revenues, how are those people going to value it? Those people who are, say, the Series B investors, they're going to be thinking how also they're going to sell their company, i.e. if they invest in a company at 100 million, they need to imagine that someone in 5 years' time will pay at least 400 million for that company. Because obviously not all their companies are going to 4x, but there needs to be an imaginable scenario. And that valuation probably would be a company which is EBITDA positive, cash flow positive, will be based likely on a multiple of profits, EBITDA, cash flows, or revenues, which is kind of a proxy for profitability. So you kind of work backwards for what's available in the market to price a company which is at the early stage. And you do a good market analysis on. That's why assessing the size of the market.
Yes.
How big is the market? How big can the company become? And
very important.
Exactly. And you run these percentages of market penetration as a way of trying to imagine what the future value will be, and then you do a discount to that, not a DCF, but just a hard discount to price.
What do you mean? What's the difference? What do you mean hard discount? Like just apply 50%? Just like that?
Yeah, or just say, listen, I need to make 3x, so I can imagine how this company, if it reaches this level, will be valued at 300 million. So then I should not pay more than 100 today.
Let's say, and what I want to reach with you is to see how we can most effectively and efficiently predict, for lack of a better word, the valuation of that company that me as a high net worth individual wants to kind of invest in. And that valuation is not because it's a utility valuation. So this is a utility valuation. I'm buying this because the utility or the functionality of this for me to use. The utility of my investment in a VC is, like you said, it's the return on investment. So will my $1 become $3 in, let's say, a period of 24 or 36 months or not? That's kind of the first principle thinking that my mind works. Do you agree?
Absolutely. And also it's very important to say that we're talking about buying the company, but really we're financing the company. So
it's an equity because it's not. I'm talking strictly about equity financing, which is
absolutely. So, but venture capitalists are injecting money in the company to hire people and build products and open offices and do research.
Yeah.
They're not buying the shares of the founder at such an early stage.
Yeah.
That's very important. So that's why there is a business plan which shows what the cash is going to be used for, the use of proceeds. And that's going to create value, whether that value is proof of concept, revenues, gaining clients, building a website, building a product, and whatnot. And so the investors should look at what's based on their experience and the quality of the management team, their ability to execute on that deployment of the cash, and what will be the value of the company at that stage, because they know what other investors, whether themselves or others, in 2-3 years will value the company if it's achieved those things.
Upstream or downstream sort of.
That's why I'm saying, of course, it's difficult to do it at the early stage, but if you kind of bootstrap from one round to the next, the more mature the company is, the easier it is to value it.
Of course.
And then you can work backwards.
So if we dare to put, I would say, standards or a blueprint, if I start a company today, in 18 to 24 months, it must have a meaningful value. Do you agree? Not just multiples.
Yes, I mean the hope is that if you're financing and you're putting human resources and capital to work, there's going to be a productive outcome.
Exactly, you will be able to at least engage in some sort of a meaningful discussion to put a value on this company today with a clear prediction of, and that value is a value based on the future potential of the company.
Yes.
I mean, mind you, I agree with you. Anything before that, let's say anything before the 18 months, let's say 12 months, 8 months, valuation is a meaningless game unless it's part of a hype that everybody's just, kind of giving free money and that money is kind of returning quickly. That's a different story. I'm talking about the specific, stable sort of valuation of a venture, and that by month 18, you are able to, within the, let's say, between month 12 to month 18, you should be able to base it on certain fundamentals, and these fundamentals are forward-looking to kind of bring forward the valuation from the future to today, discount it, and then be happy with the kind of acquisition of that shares in that time.
Absolutely, that's right. That's exactly right.
Okay, so what is wrong with DCF in that case?
The only thing that is, it's not wrong. It's the uncertainty on the outcomes, the uncertainty on the cash flows. So the more, particularly if it's a company that's innovative, it's trying to do something that's never been done before. It's trying to create a product that has not been tested before. Then our ability to know what the value of those products, what those margins will be, is reduced relative to a more predictable company like Salik or a manufacturing company or any company that's been, a retail company, etc. Which the inputs, they have a lot more certainty on the inputs. That's the difference. That's the main difference.
What if we're able to model it somehow? So I'll give you a small example. Let's say I'm building an app, and this app has a market. Now, immediately I was able, obviously, like we both agreed that at the get-go, I need to understand the size of the market with a great deal of confidence, right? It's not just coming from my hat or from my sleeves. It has to come from a real study that has happened. And let's say the market size is, for argument's sake, 500 billion, right? As a market size. So we know that the pie is big enough for me to kind of grow to a point where the venture becomes with a worthy exit. So that's point one given. Now, I'm building that app, or I'm attacking that problem, or I'm trying to, kind of position a solution for that problem. Now, the risk is, people don't care. It's a vitamin, not a painkiller. So I build the best next thing after sliced bread, but then I put it to the market. The problem is real. The market size is big. But exactly. So a great example is Google Glass. Right?
Yes.
It was massive. It was huge. Now glass is becoming, or glasses, smart glass, but 10, 15 years ago, it got nothing. No one cared. On the contrary, it had a backlash. So that's an example for that. And that's one of the major risks. There's also the risk of the ability, the competency. I can talk the talk. I can
execution risk.
Execution risk, right? Okay, great. So those are two risks. What other risks are there as an investor? We'll attack one at a time, but those are the two main risks that I can think of.
The other risk is market risk. So the possibility that the market study that you did is, the market is not exactly
the market size
or the nature of the market or the need for that service.
Okay, which is a lower risk if there is, let's say, a very kind of multi-study that points to the same thing.
There's also it's also called market risk, or the risk of exogenous factors such as, for example, there's a drop in consumers' disposable income in general because there's a recession or a spike in unemployment, like
COVID or whatever.
Exactly.
Yeah.
Wars,
so
geopolitical risk.
Exactly. So that's kind of a quote unquote
the macro risks.
The macro risk,
as
exactly,
opposed to
which
the
is
specific risks,
which is across everybody.
Yes.
Which is fine, and that has usually a lower discount, right?
Yes. It's for an early stage company, it's less of a factor.
It's less of a factor.
For the later stage companies where everything else is more predictable, then the macro risk becomes a bigger risk.
Exactly.
Yeah.
So let's put that aside for a second, or control for that. So let's kind of control for that. So now we have those risks. The first risk is the competency of the people, the ability, the execution risk.
Yes.
The second risk is, which is what we discussed, the adoption risk, which is how people are going to kind of do we have any other risks that can make that whole formula much riskier?
Competition, the risk that...
Okay, good. How the barrier to entry, so when I do it, someone else can do... Exactly. So how far people can be or can beat that product into making it, let's say, commodity instead of it being a hyped product, right? So that's a third one. Okay, what else?
Yeah, well, the fact that we may be in a market where there's multiple people who are entering at the same time, or people who are already there. Can we take market share from them? That's the competition risk.
Exactly. So the
somebody
competition
executes
risk,
better.
Exactly.
Somebody has a better product market fit, slightly,
so
which makes the whole difference.
Exactly. So I call it the kind of either barrier to entry or how easy it, or ease of kind of entry to the market. So
the moat to the competitive risk.
Exactly, the moat. So the moat risks. We have the market risk, and we have the execution risk, or the competency risk. What else?
These are definitely the major
ones.
Yes.
I mean, the rest,
and the macro risk. Yeah.
The macro risk, exactly. Yeah. So those three. So let's attack one at a time. So let's talk about the execution risk.
Mm-hmm.
How easy it is to quantify that execution risk and actually understand it and sort of control for it.
I think it's one of the most difficult ones to assess, but that's also why investors like entrepreneurs or founders who are not first-time founders, who've done it before, that's the ideal scenario when a founder has actually executed something similar. And whether they've been successful or they failed, by the way, I mean, a lot of entrepreneurs, the founders who fail learn a lot as well. Sometimes some investors believe that they learn more than those who succeed. But of course, it's more exciting to back a founder who succeeded. At least once.
Headlines. Yeah. Yes, exactly. Okay, so
the experience, the track record, is a mitigant, but still, nothing is ever guaranteed.
Exactly, and usually it gives an unfair advantage to those who never did it, and therefore it just kind of locks them. It's like how do I say it? I wouldn't say racist. What do you call it? Like experiencist. Right?
Yeah,
because you don't have experience, therefore you are kind of...
It segregates in the favor of the experienced
exactly,
yes.
which is an unfair advantage that we need to kind of solve for, right? So my philosophy is the way to solve for it is are you a subject matter expert in this vis-a-vis, have you done something outside of the venture, but you're actually, which is a clear founder market fit that we always
so sometimes, founders come from big companies like could be Google, Microsoft, or Procter & Gamble, or where they've worked with the product, or they either know the product or the consumer or the market. So they can be first-time founders and of course be successful, but they'll tell you, I've been working for Henkel all my life, and I really think consumers need this kind of, new beauty product or cleaning product or whatever it is. That's a valid experience.
Which is valid experience that controls for that risk. Another part that I sometimes see is the strength and the competency of the business plan, the plan itself.
Yes.
Is the plan executable? And when it goes to the scrutiny of discussion, and especially peer reviews, it actually goes through, and the ability of the people to actually explain that plan, it kind of controls for the experience. Do you agree?
Yes, experience, and also just being built with solid assumptions,
Yes.
Research backed.
Okay, so that's an easy risk to kind of mitigate or manage. The second risk,
It's not easy. There's ways to.
okay, I love how you're very particular about words. It's not easy, but it's clear enough.
There's a path.
There's
Yes.
a path, exactly.
Yes.
It's clear enough. It's not easy, I agree, granted, because anyone can kind of talk the talk, but when they walk the walk, it's a completely different thing. 100%. I love what you said. Second is the market risk. The way I see it is if I have someone who has claiming that he has the next best thing after sliced bread and he's raving about it, it's like, okay, do you have $1,000? Let's just tease the market with it, with a small section and see what they say. If they pounce on it like a tiger pounces on a gazelle, then at least you have something to show for, which is the initial unit economics. Is that an acceptable sort of control for the market acceptance risk?
Tinkering in the market, testing products is a very smart thing that entrepreneurs do. That they do tests, they do pilots. Yeah,
exactly.
And that's often used also when you're an existing company and you just want to test different products or different
on the side,
or different modifications to your app or to your software or to your product. You do a test in a certain city or with a certain group of clients. It's a great way of mitigating the risks. Yeah.
So as a startup, if I have, let's say, an idea, I can even as little as create a small video that is kind of really well produced, that has the hook, that has everything, put it online and see if people actually watch it it goes viral or not. Because if it does, wouldn't that consider that there is a real need for the market? I know it's not as good as a track record of, let's say, 3 years of selling, but at least does it control to a certain degree that risk?
What you really want to see is whether people will pay for the product and whether what they will pay for it will make it sustainable and profitable. Because people can love a video or they can love a sample, but the question is, are they willing to pay for it and how much?
So the
product or the service needs to be sustainable from a pricing perspective.
So what I would do, for example, let's say a client came to me and they have the best idea in the world and they have, this is $1 billion idea. And he's like, okay, great. Let's first make sure that we tease the market and then we put it in front of people because, venture has to solve for a problem and it has to be a painkiller, not a vitamin, meaning it has to be, the problem has to be painful enough and the solution has to be quick enough for people to actually be interested in it and therefore pay for it. So I tell him, okay.
And sorry, because this is a very good point, because I meet so many companies, startups, early stage founders who have a very exciting idea. As you said, it's a cool idea. It looks great on paper. But then there is a number of issues, which is, the market is so small or the market is much smaller than you think it is. And then within that, the people who are willing to pay a price is even smaller. So some products, particularly in fintech, can look very exciting and they solve a pain point, but what people are willing to pay for them, is such that you need such massive adoption that the product, for example, will never be profitable in the Gulf, in the GCC, in Saudi Arabia and UAE, because our markets are just
the critical
too
mass
small.
is,
yes, you need hundreds of millions of users.
And also regulation?
Potentially, it could be regulation, but it just assume that the regulation is there, there's a product, there's a price, but the margin generated from that product means that it will only be profitable if you are in India or China or the US. And it will never work in Saudi Arabia because you're a 40 million country.
But that can be modeled early on to be able to understand that.
Yes, but you could also get it wrong. You could also think that the price is going to be 4 riyals, and then you discover that it's 4 fils or 4 halalas.
Yes, yes.
But so that's.
But if we do let's say we do the just kind of go through this process. So if we do the video went viral, and then we start offering it at a very low price, discounted, just to kind of see if, let's say, within 1 week we get a data spine or some sort of a unit economic of 10,000 active users, daily active users. Right, in a span of a very small period of time, then we can model if we put it to the price and then we can test the price, and then we can start adding frictions and adding prices until we are reaching an equilibrium. But then because of the amount of people that kind of came in initially, we're able to model And that can happen in a very short period of time, talking about weeks and less than 3 months, the whole sort of practice. 2, kind of, and this is still no investment money, nothing. I'm just trying to build my thesis based on empirical evidence of testing the market, excitement, data spine, and unit economics, and then price point. And that can happen in 3 months. So if a startup, and it can happen very cheap because you can do it on a small sample size, that can then be good sample enough to kind of scale and kind of give it to the entire sort of region or your market. So if I do this in 3 months and I got that, would that be accepted to, let's say, investors or investment bankers or valuation?
It will definitely be a great backing for the business plan and for the investment cases and the investment thesis. It will reduce the uncertainties. When you go and you say, listen, we've tested this with 1,000 or 10,000 consumers, and X% of them said they were willing to pay, 4 riyals for the product. Then it will give investors a lot more confidence.
Do startups and ventures, to your knowledge, of course, I know that you're not in that domain, you're kind of in the M&A, but from your kind of ecosystem and being in the ecosystem, do startups actually use a methodology and structured methodology to kind of appease to those investors and make sure that they give them the comfort enough to invest in them? Do they do that?
Yes, because usually startups, they very quickly go to market and start testing some form of a product, right? And then they come to investors to develop the product more or take it to more markets. There's usually, there's very quickly a stage where there's been a product market fit, some amount of product market fit. The uncertainty remains on how much it can scale. If it worked in Dubai, will it work in Abu Dhabi? If it works in Abu Dhabi, will it work in Riyadh? And so on and so forth. So there's like a reducing number of uncertainty as you test the product more and more, but there's still execution risk at every stage of the process.
So I saw a report the other day, I can't remember, I think it was from Magnet. It says 7% from seed companies make it to Series A. Yeah, it was from Magnet, 7%. Now that's the lowest worldwide. In the US, it's 27%. In Asia, it's about 14%. Yes. If people do that, then why can't they make it to Series A? And 7% is a ridiculously low number. That means 93% of those companies just vanish, or kind of whatever happens to them.
The reason for this is that we didn't discuss the structure of the market in our region relative to the rest of the world. The way the market is in our region is that there is a lot of money that's dedicated to funding very early stage companies such as pre-seed and seed companies. And then as you go into the later stages, I think there's a decent amount at Series A, but then it drops very sharply after that.
Wow.
So the amount of money at the very early stages the availability of it is disproportionately high relative to other market structures. Like, for example, the US is the most mature market where there is a very good amount of money at all the stages.
So the pipeline and the stages are clean.
Yes, it's much more mature. Our market is relatively younger, so it's normal that we have more money at the early stages. Now the funds are starting to launch growth funds, so that continuum of financing from seed to Series A to growth stage to private equity is still being built. Our ecosystem is still growing and evolving. So because there's a disproportionate amount of funding at the early stage, I'm going to say this in the bit of a Silicon Valley way, which may be seen as a little bit mean. A lot of the companies which should not have been funded got funded.
Oh.
Potentially. So that's a negative way of looking at it.
Is it bad valuation or bad...
No, it's overexcitement at backing early stage companies, potentially. And also the flip side of that is maybe there isn't enough later stage money, whether it's Series A, but Series A, there's a decent amount of money. So
is it lack of capital or lack of structure to hold those funds?
I think, to my honest view, just not to be too theoretical, is that it's a combination of the fact that there is too much capital at seed, and not enough at the later stages. It's both.
But so I need to understand this, because capital is capital. If I'm an LP, let's say, and I have, I don't know, my net worth is 500 million. What stops me from financing those Series B growth companies?
Because at Series B, to pick your example, I mean, the amount of money to make a difference is much higher. You need at least 20 million. So there isn't enough of funds who are, and to do 20 million tickets, and you probably want to, in a fund, to do at least 15, 20 transactions. So you need to have a $300, $400 million fund. There isn't a lot of those 300.
Is it the lack of capital or lack of fund structure?
It's no. There is no shortage of money in our part of the world.
That's what I'm trying to say.
Where there is a shortage is funds which are dedicated to that stage of investment.
Why?
Because we're still under construction. We're still under construction. Yeah.
How difficult or how long does it take to create that? Because I've been hearing this story for years now. I mean, it's
a bit of a chicken and egg because the economies are relatively small, there isn't that many great companies which get to that stage. So what's happening now is the great companies who are getting to Series B or C, they are getting funded by international investors.
Yes.
So you see that with the property finders of the world.
Yes.
We have some lovely success stories. Kareem, got funded by international investors, then got bought. Amazon got funded by Tiger and Souk got funded by international investors, then it got bought by international. So the good companies, because there isn't a lot of them, the international investors are managing to scoop them up. Local, regional investors would love to have funds, but regional investors are going to have a fund that's dedicated only to the region. And they probably feel that there isn't enough good opportunities to justify having a $300-400 million fund. So that maybe that's a little bit backward looking, but people are now launching those funds. So there are examples of people launching the 300 and the 400 million growth funds. Friends of mine, I'm very excited about it. I wish them luck. It's happening. It's finally happening. But for that to happen, you needed so many companies to develop and grow, and they need the economy and the ecosystem to grow. Because if you're dedicating a fund to the Middle East, you need to be able to do 10, 15 good investments.
Deals, yeah.
Yes, exactly. And if there's not 10, 15 deals to be done over whatever the deployment period, say 2 years, then there was no reason for that fund to exist.
But how is this related to the 7% from seed to Series A?
It's related, again, there is so much money at seed level. And I'll give you examples of companies who fail or companies who get funded and we are surprised to see them getting funded. The easiest test...
Because?
And I'm going to give you a typical example, which maybe you're going to disagree because we like to have this friendly disagreement. I see so many business plans coming to us at seed and people just asking us friendly advice where the product or the service has never been done anywhere else in the world.
Okay.
And the founder says to me, I have this amazing idea. I'm going to launch this company in Qatar or in Abu Dhabi or in Dubai. And no one has done this ever before. And I look at them and I say, are you sure no one has done this before? And I do the research and I'm like, no one has done this.
Actually.
No one has done this in Paris, in New York, in Silicon Valley. I'm like, there's only two possibilities here. Sadly, the most likely one is your product is not viable.
There's a reason why no one did it.
Because somebody tried it and we haven't heard of them. They never survived the seed stage. They never came.
Survivorship theory, bias.
So the great thing about being in emerging markets is we can see the success stories. We can see, we are like...
We're behind. We can see in front of us.
We can see in front of us. It's a benefit. It's not a curse.
I agree.
It's a beautiful thing. It's actually something that we use to de-risk investment decisions. Now, it can be misleading because sometimes we see very exciting success stories and we think we can replicate them. So that's a risk we have to take. But if you are trying to do something which has never been, which is like there is no clear champion, there isn't $1 billion company in that space, it means that it can't work. Okay? Or if you're really an amazing...
At that scale.
It's just, if it's not going to be, if a company reaches $1 billion size in the US, what's its little brother in Dubai or Saudi going to be? $300 million company? So if there is no hope of this company becoming a $300 million company, why would anybody fund it at 20 or 50? Because you fund it at 20 to sell it to someone at 100 who sells it at 300.
At 300, yes.
Yeah. So, nobody wants to build a business which is going to become...
But how do we do disruption then?
So no, I just want to finish that.
Yes,
There
yes,
are
yes.
some amazing innovators from this part of the world who have built global businesses, but they are the exception. It's the tip of the iceberg. So it's very, very rare. And sometimes they build them here. What I often say to them, if your product is so amazing, you should go and build it in Silicon Valley. I mean, sadly, I don't want people to leave from here to Silicon Valley, but I mean, if it's really an amazing, which has never been done before, why build a 300 million company here? Go do a 3 billion company in Silicon Valley, and we'll have a proud Arab founder in Silicon Valley, which we will celebrate, you know? Or maybe you can build it from here. And a few of my friends and clients have built products which are in the top 3, 4, 5 globally.
But like you said, that's the exception.
That's the exception. But this 93% of companies who fail, I haven't looked at the list, but I'm sure includes, I know it does, a large number of companies who try to invent something which doesn't work.
Why is it from here, not from other parts of the world? I mean, why is it 27% in, let's say, Silicon Valley?
It's happening in Silicon Valley as well. Except in Silicon Valley, the VCs are much more ruthless. They see something that they think is highly unlikely to work, they won't fund it.
Right.
That's why I'm saying that
Is
here...
it maturity of
Yes, because they're
investors?
experienced, etc., and they know they're in Silicon Valley. They know what works, what doesn't work. I mean, they know that a lot of ideas are innovative, but they're going to fund the higher probability ones. Because obviously there's a ton of innovation happening in Silicon Valley, and VCs must see some super exciting stuff, which our mind cannot comprehend. And a lot of it they're going to discard. That's saying, listen, that's a dream. It's a very low probability. That sounds exciting. It has a higher probability. Let's fund it at 50 million valuation or more.
What do you think of the ecosystem itself? I mean, the other day I was talking to a close friend of mine, and he said the tax system in the States incentivizes those kind of big players to kind of give money to the VC and to kind of all of those kind of early startups, because if they don't do it, they'll give it at the tax. They'll rather give it to the VC, and therefore that, luck favors the ones who are prepared or the ones who are keep on trying, because the laws of averages will kick in then. We don't have that incentive system here, and therefore most of the people will not invest in startups, and therefore the laws of averages brings down everything with it. What do you feel of that?
Well, first comment I want to make is obviously we're very lucky to have not much of an income tax here and very little corporate tax. So tax incentives work in countries which have tax, and I don't want to wish on anybody to have more tax.
Yes.
Where the US system is seen as favorable from a tax perspective is when you compare it to Europe, because Europe has a taxation system which is overly heavy and particularly unfriendly towards innovation.
Yes.
And they have some absurd things like taxing carried interest.
Yeah.
So investors who have carried interest and they haven't even earned the cash need to pay cash, tax on it. So Europe has done itself a disfavor with its tax system, and the US have done a good thing. I think from a tax perspective, we are in a tax, and we are in a friendly environment in our part of the world. We should not be complaining about tax.
So not complaining, but finding solutions to actually see how we can apply the laws of averages and have these people that have all those cash actually pump it more into VC instead of gold and real estate and other, because this is the competition. Do you agree? This is the competition. I mean, if we have enough cash going into VC, not enough cash going to VC, that means, because we agree that there's no shortage of capital, then that cash is going somewhere else in all of those kind of asset classes that exist. Mm-hmm. But if we say, for example, let's take corporate tax. Is it possible from your, kind of obviously it's an opinion. Is it possible to say, for example, we will give you 2% tax cut on the 9%? So if you give it to kind of VC instead of giving it to us, is that possible?
I think maybe we can broaden the topic a little bit. So what can governments and regulators do to encourage more entrepreneurship?
Give incentives.
More incentives.
From a capital perspective,
yes.
Not from the kind of investor, not from the founders' perspective. Because founders, they're giving, visas, they're giving facilities, they're doing all of those kind of, events and, awareness and all of that. So there's lots of things that are happening there, but then there's little that to me sounds like it's incentivizing that part, which is the capital market.
Yes, I think one of the things that would be helpful from governments and regulators is reduce the barriers between the economies. Because, if the GCC, for example, or even we could dream of the entire Arab world had less barriers and less, more, passporting of regulations. The fact if you're regulated in one place, you can do business in another, or you can ship your goods and services across borders more easily. That will help the entrepreneurs because it will give them a bigger market. Because our countries taken together have a big population and a big GDP. The issue is the borders that we have and the differences in regulations, which make our markets fragmented. I think that's where governments and regulators could help the most.
I read the GCC official economic report, and it says that the AUM for the GCC combined is around 5 trillion, the assets that they're managing. But the intra-GCC kind of economic transactions, or let's say FDI within the GCC, is only 18%. What do you think of that?
So you're saying the trade between the Gulf countries?
Yeah, the trade. So the intra-GCC trade is only 18% of that sort of larger AUM.
Yeah, I mean, our countries are very wealthy. They produce a lot of wealth because of the natural resources. And now also we have population growth and a lot of things are going for us.
Diversification of exactly.
So the amount of wealth that we have is a bit disproportionate towards our economies. So we have more wealth than can be invested in our economies. That's why we export capital. And we're not the only ones. A lot of countries export capital.
The sovereign wealth funds and others.
I mean, Japan, for example, has a huge surplus. So we are surplus countries. So it's not a value statement about, something is wrong in our economies. I think, if anything, over the last 10 years, we've seen the sovereign wealth funds invest more at home than previously. So there's been a bigger focus on investing at home. And I think that's continuing.
One macroeconomic ratio that I haven't seen much in any of the reports is DDI over FDI. Have you heard of this ratio before? Does it exist even? So domestic direct investment.
Interesting,
versus
we should check it.
Because I looked for it and I couldn't find any of that. And, internally, so foreign investment versus local investment.
Yes.
I haven't seen, and if we kind of do it across the GCC, that will give us a better understanding of, okay, are we accepting more cash than we're reinvesting within? So outside of the GCC itself, don't you think?
I think you make a very good point. But there's been action on this by the sovereign wealth funds, in particular in UAE and Saudi Arabia, where they've taken specific actions to invest more at home. So you can look at the situation as it is, but you can also look at its evolution, and it's moving in the direction that you're advocating for,
right?
Which is more investment at home.
Because
which makes sense because we have very promising economies, young populations, growing populations. The size of the population is becoming much more relevant from an investment perspective. Yeah.
Do you see and this is kind of towards the end of our discussion, do you see the VC market specifically contributing far more, so that 7%, so the 93% that kind of leak from that pipe between the seed and the Series A, do you see that, or is there any kind of indications of that being repaired?
I think so. As I said, a number of my friends and clients are launching growth funds, which are going to invest in these later stage companies. The existence of those funds is going to give a clearer line of sight for the investors investing at seed and Series A, that there's going to be someone who will support their companies either by financing them or taking them over at the later stages. So it's happening as we speak. It's something I've been, advocating for and hoping for a long time, but it's confirmed.
What about corporates? I mean, you deal with corporates and obviously...
Sorry, the other positive development is the availability of debt. Because we're talking a lot about equity.
Financing,
yes, exactly. So a lot of...
Do you think that's a good thing?
It is a good thing because our...
Relative to equity financing.
So structurally, our entrepreneurship system, not just in startups and technology, in general, the private sector, in general, has less access to debt financing than in other markets, like in Europe or the US.
But that should be a good thing, isn't it? Because interests and kind of all of the kind of issues that comes with it. It's
all about having a balance, of debt and equity, and for a founder or...
Because for VC, you don't have collateral. You're not...
True. I mean, not necessarily at the VC stage, but if now that there is more availability of private credit, for example, for mature, even slightly young companies, the fact that these companies can get financed with debt will encourage the seed and the Series A investor to finance them, because
Yes.
they know there is a non-dilutive form of financing that can come if they deliver on that business plan.
There's a light at the end of the tunnel.
There's a light at the end of the tunnel, and it's a non-dilutive light.
Right.
So it's not just another VC
Right.
or P who's going to dilute you.
Yes, yes,
You know, in
yes.
every round,
Your percentage will not go down in the
I
company.
mean, it comes with its own risks and costs. And of course, I always say nobody goes bankrupt because of a bad business model.
Right.
They go bankrupt because of a bad capital structure.
Yeah.
But debt, when used with prudently and wisely, is very supportive for entrepreneurship and for equity investment because, leverage improves the returns. And when equity investors have the prospect of better returns, they will be more likely to
have
invest.
high leverage, and therefore they'll be able to have
Or
more.
some leverage, yes. It
Or
doesn't have
some
to be-
leverage, exactly.
Yeah, reasonable leverage, yes.
And that leverage, what's that leverage exactly? Is it that value that they're creating as VCs? Is it, for example, all of those things that we discussed?
It's simply, say that, you finance the company as a VC, and you know that, for it in 3 years' time, it's going to need to open an office in a different country.
Right.
The fact that it can get debt financing to open that office without diluting you encourages you to finance it at this stage. And
As
so,
a founder,
as an equity investor,
as an equity investor.
Yes.
Okay.
even if the debt is not available now, but let's say we're supporting a company in Dubai, in UAE, and we're going to open offices, branches, whatever, launch products in Dubai, Abu Dhabi, and Al Ain. The fact that another company just got funded by a private credit or a bank to open in Saudi gives us hope. Yes.
Yeah.
So we can have a business plan which says, in 5 years' time, we can open in Saudi with a combination of debt and equity, which will be less onerous from a dilution perspective.
Right. So it allows us to gives us more scenarios when we do
more scenarios, more options. I just wanted to mention it as an option.
Right.
Because you asked me how the ecosystem is gonna do better. Well, it will do better with new funds which do growth, a more developed private equity ecosystem, more debt providers, also IPO market which is more vibrant across UAE and Saudi. So these are the kind of
option. The more options you have at the end, the more you will have people in the middle. Let's say in the series A and B to give money to those people who are coming from seed and beyond.
Exactly.
Okay, so it's really a macro ecosystem sort of study that needs to happen. Of course, add to that the kind of segmentation of the market and the cross-border sort of transactions, whether it's for capital transfer or goods and services transfer, that also needs to be looked at. What about corporates and corporate, kind of funding? Because every corporate has its own, especially the big ones, let's say the Votames of the world, the kind of Haptours of the world, and all of these people. I see in the West and other parts of the world, mega companies and kind of large enterprises, they have their own investment arms that actually does VC because they want to have those VCs actually sometimes at the point in time acquired by them. Is this something that you see
Yes,
here?
you're referring to corporate VC, which we've seen some decent amounts of activity. We worked with Aramex a lot on their corporate VC. And you mentioned Al Futtaim. Al Futtaim also has done some corporate VC investing.
Is it as active as you would want it to be? Not for those brands. We don't want a single, companies, but at an ecosystem wide. Is it actually contributing meaningfully? It's
a great question. I would love to see more because I see corporate VC as a higher expected return activity than just financial VC. Because a corporate VC, whether you're a family which is involved in retail or in auto dealerships or in financial services, whatever it is that the corporate has a center of excellence in, that can be used to support the startup way beyond the money.
The cash, yes, exactly.
While a VC, they bring money and they bring their expertise, but
it will never be.
It's a different, scale,
attention and focus
of support and expertise which goes beyond the money. It could be contracts.
What could we do as an ecosystem to push? Because again, there's no shortage of capital. Let's agree to that, right? Which means there's no shortage of companies that has this cash. Whether it's in the form of actual cash in the bank or otherwise revenues and so on. What can we do more as an ecosystem to give incentives to those corporates to participate even more in a meaningful way in the VC market, in your opinion?
Good question. It's a good question. I think I think we should celebrate them, just like I did.
Yes, give them headlines.
Yes,
I agree.
yes. Give credit where credit is due. Celebrate the success stories when they happen. As intermediaries and consultants, we should remember to call the corporates as well when we're raising money for the good startups. The VCs can also participate in that by approaching the companies and bringing to them their best, approaching the corporates and bringing them their best companies and offering them partnerships, which consist not only of cash but also commercial agreements. So I think everybody in the ecosystem can do their part to increase the participation of corporates.
The last part of this ecosystem, which is the part that is mostly talked about, but in my personal opinion, anecdotally, has the lowest sort of contribution in a meaningful way. And I could, obviously, this is my perspective, I could be wrong. Incubators and accelerators. How do you see their role? Are they actually living up to their role here in the region or no?
I'm not very familiar.
That's enough question for me. That's enough answer for me. I mean.
But I think there's also just to segue. I think Shalhoub had an incubator, which was kind of in between an incubator and a corporate VC program. So it's also another area where corporates and conglomerates can play a nice role in supporting the ecosystem.
Most of the companies that I know worked with incubators, accelerators in the region. They, and this is their words, and I quote, they're real estate agents. They just want to make sure that you're able to pay them either as a training, quote unquote, or to pay them for an office space, and that's it. They have employees who are not entrepreneurs themselves,
yes,
who are guiding them through their entrepreneurship journey, which defeats the purpose of having an accelerator and incubator. Juxtapose that or compare it to other parts of the world like the YP or other kind of incubators, accelerators in the world who made companies that made headlines. It's day and night difference. Do you hear these stories as well?
I wasn't even going to mention, because most of the ones I know are actually real estate companies or company formation companies, who help you get your license, open a bank account. So, I mean, it's a form of support, but I mean, it's not even support. It's a service.
It's a service.
You're offering a service, which is real estate license.
So that's a big gap as well that we have. So corporate, kind of enough corporate, how do I say it, VC or investment arms in the VC market, but also incubators and accelerators. Now, of course, you said also the kind of growth funds that is also now being developed. We also talked about debt financing and all of that. And if all of those, and it's a little bit from the government as well, if they kind of give tax breaks to those corporates, instead of 9%, let's say 7%, and the 2% are, you're able to kind of invest it in VC, and you structure your sort of accounting around that. How do you see if all of this kind of aligned in the way that you and I discussed now, how do you see our region from a VC perspective? What else is missing?
I think we're going in the right direction. I think I'm optimistic. I think, in the past, we've had some, let's not forget the macro part, with COVID and the wars and all these things, the volatility. That does, in the end, impact the exit. So a lot of my friends who run VCs, one of their pain points has been generating a good exit for their limited partners. So, and some of it is despite having selected very good companies, financed them at decent valuation. So they've done their job, but then the market at the end wasn't there, whether it's the M&A market or the IPO market, for a variety of reasons, which are often not in the control of the VC. So I'm optimistic that we're going to see more exits and more good success stories, which will help encourage everybody all along the food chain to invest more.
Where do you see Awad Capital in 5 years?
Continuing to support the ecosystem across all most of these stages. We get involved more at the mid stage, from the mid stage to the growth and exit stage. So just we're growing really with the ecosystem. I mean, we've been around. When I started, it was more than 10 years ago. There wasn't really a lot of tech companies. And obviously, we were a generalist investment bank, and we still are, although everybody sees us as the tech investment bank. And that's because we've grown with the ecosystem. I mean, I met Kareem when they were raising around at 30 million. And
wow.
and I met
legacy.
Roni at Souk when the valuation was under 100 million. So we've grown with the ecosystem, and we're gonna contribute more and more because there's more work for us to do, helping the VCs create these good success stories, which will really help the whole machine to function better and grow.
What would be your advice to, aspiring venture builders to manage these difficulties that you and I have discussed? So in 5 years' time, where you and I discussed about all of those kind of growth and how the economy is growing, what should they do today, in your opinion?
I think
more of, let's say, yeah.
I think definitely build prudently. I think one of the things we did not mention is sometimes founders and the early stage VCs, they do too much of a good job getting a high valuation from the early stage investors. We didn't mention that point. And then because you have this high watermark at seed and Series A, it makes the Series B, even if the money is available from these new funds, it's going to make funding more difficult.
Yes.
If you're coming already with a valuation which is too high.
What makes that? Why is that?
That's because of the imbalance in supply and demand, because there's a lot of capital. So the fact that there's so much capital, there is a bit of responsibility on the side of the founder. I know it sounds a bit crazy to ask someone to
lower your valuation.
Not lower, but just control how much excitement there is around this early stage valuation, because you could be mortgaging your future.
Oh, wow.
Yeah.
Let me have that sink in for a second. Yeah. You're mortgaging your future. That's exactly what it is. Because if you're pushing for a higher valuation now at, let's say, pre-seed, seed, and we've seen a pre-seed that's valued at 50 million with a kind of a fund of 10 million. How are you going to sustain that in this market at a Series A or B? Because then it's all about the ROI, right?
Correct.
So if you need to give your early investors that 3x, 4x, living up to that it's like running a marathon but starting sprinting.
That's exactly a fantastic image, even better than mortgaging your future. So, steady. I'm not saying slow, but just you need to. It's a marathon.
It's a marathon.
It's a marathon. It's not a sprint. You're gonna exit this company in 10 years' time at 300 million. Let's work backwards from that. Where do you need to be now, and what kind of returns your investors are gonna get? Every 3 years, your investors are expecting 2-3x.
And I think that's the best advice that we should end this episode with, yes. Because absolutely it's on point. And I love that it came from you at the exact right time. So you end on a high note, because I know most founders just dream of having a high valuation early on. And I'm like, that doesn't make sense. Coming from you, that's the best advice that everyone should take. So
thank you.
Thank you very much.
Thank you, Usama.
Thank you, Ziad.
Thank you. I really enjoyed this. Cheers.